Does diversification actually work? Let's go back to 2022, where stocks dropped about 20% and bonds dropped 15% at the same time. A lot of investors looked at their diversified portfolios and asked, what exactly was the point of these bonds? And it's a fair question. The goal of diversification doesn't mean your portfolio will never drop. It means that no single bad outcome will destroy your financial plan. When used correctly, it's the most reliable risk management tool available to long-term investors. This video will explain what diversification actually promises and what it doesn't, and why 2022 was not evidence that it stopped working. My name is Quinton Chambers. I'm a certified financial planner and chartered investment manager. And over the last decade, I've helped hundreds of Canadian families utilize diversification to help them build real wealth. Now, 2022 was generally unusual. In most bear markets, when equity prices fall sharply, bond prices tend to rise. That negative correlation is one of the main reasons a diversified portfolio is less volatile than a pure equity portfolio. But in 2022, rising interest rates caused both equity and bond prices to fall simultaneously. And if you're the traditional 60-40 investor, this probably felt like a betrayal. Probably thought that bonds would protect you. Instead, both sides of your portfolio dropped. Diversification seemed to fail at exactly the moment it was supposed to help. This feeling, while understandable, misunderstands what diversification actually promises. Doesn't promise that all your assets will hold value in every type of market downturn. What it does promise is that no single bad event will take everything down all at once. Here's what diversification actually does and why 2022 doesn't disprove this. The 2022 decline was driven by a specific cause, a rapid and significant rise in interest rates in a short period of time. That particular scenario is one of very few that both equities and bonds are likely to fall. And historically, it's quite unusual and tends to be temporary because once rates stabilize, bonds tend to recover their value quickly. In every other major equity bear market, the last 30 years saw bonds rise or hold stable while the equities fell. 2008, equities dropped by 50%, bonds were positive. 2020, equities dropped by 34%, bonds were roughly flat, but still slightly positive. These are the more common patterns. More importantly, the 2022 60-40 portfolio dropped about 16 to 18%. Pure equity portfolio dropped about 20 to 25%. So diversification did provide protection, just less than in previous cycles. Here's what actually makes diversification effective and how to build it into a portfolio that uses it well. True diversification happens across multiple dimensions. You can invest across geography, asset classes, sectors, and even time horizons. A portfolio that holds global equities, investment-grade bonds, and possibly some short-duration instruments is more robust than ones that just holds equities and conventional bonds. Within equities, global diversification means no single country, sector, or company will determine your investment outcome. When U.S. tech underperforms, international value may compensate. When Canadian energy does well, consumer discretionary may be flat. The pieces move at different times. And one of the most powerful uses of diversification is time. A portfolio held for 20 years has survived multiple full market cycles. Volatility that looks terrifying in any single year is almost invisible in a 20-year return chart. Time is not just a factor, it is the factor that makes diversification work. So here's my recommendation for how to evaluate if your portfolio is properly diversified. Step 1 is to check if your equity holdings are geographically diversified. If more than 50% of your portfolio is in Canada, or 50% is in a single sector, or worse, a single stock, you have concentration risk. Step 2, review your fixed income for quality and duration. High-yield bonds and long-duration bonds are more correlated with equities than investment-grade short-duration bonds. And then step 3, consider whether your fixed income includes any inflation-linked instruments. Real return bonds or inflation-protected securities provide a different type of protection than just conventional bonds. Then step 4, think about your time horizon before making any changes. If 2022 felt intolerable, the solution may be a slightly different asset allocation, but it is almost never no diversification. If the events of recent years have made you question whether your portfolio is truly diversified, you can always book a free review with the link in the description. We'll map out your actual exposures and show you what proper diversification looks like for your goals and your timeline. If this helped you feel a little more informed and confident about your finances, please subscribe. That's exactly what this channel is about, giving you the knowledge to make better decisions so you can live a happier, healthier, and wealthier life. I'll see you in the next one. Take care.